Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Last Friday's failure of the second largest bank in U.S. history is cause for concern. Not to be overly dramatic, but any bank failure should prompt questions of the security of our entire banking system. Over the weekend, the Federal Reserve guaranteed the safety of deposits at Silicon Valley Bank and Signature Bank. The Fed also increased liquidity for the entire banking system by loosening restrictions on one-year loans against bond portfolios. While the U.S. banking system appears intact, investors were quick to vote for winners and losers in the stock market come Monday morning. Here's a year-to-date chart for the broad S&P 500 index, the regional bank ETF, KRE, as well as Schwab and First Republic, which suffered steep declines, down 12% and 61% for the day. While the regional bank ETF is down 14% through Monday's close, the largest banks, JP Morgan Chase, Bank of America, and Citibank, closed slightly up on the day. The failure of Silicon Valley Bank is an acute reminder that banks can and do fail. For investors and even bank customers, it's important to understand what happened, what the longer-term implications are, and what could potentially break next. Washington Mutual, which collapsed in 2008, was the largest, has the distinction of being the largest bank failure in U.S. history. Silicon Valley Bank is now number 2. To see how we got here, we need to set the stage a little. Inflation is bad. It eats away at purchasing power. If inflation rises 10% this year and you get paid the same amount as last year, well, you'll be 10% poorer. When there's too much demand, when there's too much money chasing too few goods, prices have to rise. As prices rise, workers demand higher wages, forcing companies to increase prices, which reinforces the inflationary feedback loop. We haven't had to contend with inflation in a meaningful way since the late 1970s and early 1980s. In our view, globalization is largely responsible for more than 30 years of low inflation. Companies moved manufacturing to emerging economies where labor was far less expensive. Sure, you have to ship product around the world, but a stable geopolitical climate and careful supply chain planning provided cheaper quality goods, and certainly technology helped make all this possible. The pandemic reduced the benefits of globalization. It demonstrated the fragility of far-flung supply chains. Even before the pandemic, a wave of nationalism around the globe further reduced any desire for increased globalization. Russia's invasion of Ukraine reinforced the need for better strategic supplies of resources, particularly energy. The significant ratcheting up of tensions between China and the U.S. promises to further confound the benefits of globalization. Products have gotten more expensive. We also threw a tremendous amount of money into the mix to get through the pandemic. The annual budget for the entire U.S. government is about $6 trillion. We spent an extra $5 trillion on pandemic stimulus between 2020 and 2022. And interest rates were reduced to zero. Armed with stimulus checks and no borrowing costs, consumers and businesses went on a spending spree. U.S. gross domestic product rose almost 6% in 2022. Corporate earnings soared 32% from the pre-pandemic high in 2019 through the end of last year. And now for the hangover. The good news is the U.S. economy, and by extension the global economy, weathered the pandemic. The bad news is inflation's too high, and the process of normalizing interest rates is painful. To get out of this cycle, demand has to be reduced. Unfortunately, the only proven effective tool is to raise interest rates. Back in October last year, when the Fed funds rate was 3.25%, that's 3% higher than the start of 2022, Scott Minerd of Guggenheim Partners stated on CNBC that the Fed will continue to raise rates until something breaks. Well, something broke. Fed funds is nearly 5% now, and with inflation above 6% and unemployment at 3.6% last month, rates are expected to have to go higher. Here's a chart of the inflation rate and the 10-year Treasury yield over the last 30 years. Yesterday, the 2-year Treasury closed with a yield of 4.1%, and the 10-year Treasury closed at 3.6%. Usually, if you go further out in time, longer in duration, the yield is higher. There's more risk, more bad things that can happen further out, usually making those bonds more risky. That's why your interest rate on a loan is higher if you extend the loan further out, say 30 years versus a 10-year mortgage, for example. Same is true for bonds, unless, of course, investors think a recession is coming. In a recession, the Fed has to do the opposite of what it's doing now. It has to reduce rates to increase demand to get the economy moving. When a recession is expected, investors anticipate a rate reduction. So right now, today, you get a higher yield on a 2-year bond than a 10-year bond because the market is sure that the Fed will have to cut rates again in the near future. That's an inverted yield curve. Much like the overly lenient mortgage terms of the early 2000s did for Washington Mutual, the ultra-low rates of the last few years contributed to Silicon Valley Bank's failure. Imagine you're a bank. People give you money for safekeeping. It's a competitive business and your customers don't want to pay any fees for you to hold their money. But you need to keep the lights on. You need to do something with the deposits, something safe. You loan some of it out to companies and some for mortgages and some of it you go buy bonds. You might pay a little interest to your customers, but your goal is to make enough on your investment portfolio that you have some profit at the end of the day. Bonds are relatively safe. The bond market doesn't move much. You collect your interest payments. It's pretty predictable. Over more than 100 years, the bond market hasn't declined more than 5% until last year. Bonds, particularly if you buy longer-term bonds, are sensitive to significant increases in interest rates. And interest rates have moved higher recently, very rapidly. If I buy a bond that pays 1% for the next 10 years, and after my purchase interest rates move to, say, 5%, no one's going to buy my bond from me if I need to sell it. Any buyer will want a discount. They'll want enough of a discount that the 1% coupon will work out to something better than 5% when the bond finally matures. My principal is guaranteed by the bond issuer, but I might only be making 1% for the next 10 years or so. That's the duration of the bond. If I can sell it, well, I'll have to sell it at a loss. Last year, the bond market dropped an unprecedented 13%. The global bond market dropped even more, 16%. It doesn't seem like much compared to a stock market that regularly rises or falls double digits. But this is the bond market. Banks put a lot of money into bonds. In fact, the size of the bond market measured in dollars invested is double the size of the entire U.S. stock market. It's about $40 trillion in value. A 13% loss is about $5 trillion. That's 1/5 of the entire annual U.S. gross domestic product. The bond market matters, and the losses last year, well, they were big. Silicon Valley Bank had a large concentration of big customers. When the extent of the damage in the bond market portfolios started to become apparent, when the bank started looking to raise more capital, depositors started to withdraw their funds. To honor those withdrawals, the bank had to sell assets, including bonds, at a loss. With increasing defections, the bank couldn't keep up without locking in even larger losses. The bank failed seemingly overnight. It was a classic run on the bank. When the economy is good, everyone looks successful. When things are more difficult, the cracks in the foundation become more apparent. This is true for any company in any sector. Yesterday, the financial institutions with weaker balance sheets, weaker financial health, sold off precipitously. That's not to say that First Republic or Schwab are likely to fail, but investors should tread carefully. A portfolio of low-yielding bonds will impair bank earnings for years. The Federal Reserve meets next week. With a strong labor market, unemployment is low at 3.6%, and inflation still persistent at 6.4%. The expectation was that the Fed would increase the Fed funds rate by 0.5% to get to 5.25% on the Fed funds rate, with more increases to come, possibly reaching 6% by the end of the year. The failure of the second largest bank in U.S. history has put the prudence of further rate hikes into question. The market now expects the Fed to pause at the meeting next week until more data can be assessed. Bank depositors at U.S. financial institutions should generally not worry too much about the safety of the deposits in the bank. However, banks can and do fail. Remember that deposits are insured up to $250,000, but even beyond that, it would be extremely rare not to be made whole on deposits. But you can't count on it. As an equity investor, however, owning shares in a failed bank is a disaster. You will be wiped out. Things are not done breaking. The Federal Reserve may pause interest rate increases to let the dust settle and not create more of a crisis. A pause will likely result in a brief rally for stocks. We do have to fully rein in inflation, and that will take some time. Until we see significant improvement in inflation data, rates will have to go higher and the Fed may break more things. To be clear, it's not the Fed that caused the Silicon Valley Bank failure. The bank made investments that turned bad with a steep rise in interest rates. Good companies that are well managed will continue to perform and will do even better with when the macro environment improves again. But we're not there yet. Ultimately, earnings are critical to stock market performance. Earnings will improve, but they may have to get a little worse yet before they can get better. In the meantime, bonds, including Treasury bonds, pay an attractive 4 to 6% yield. We don't anticipate significant further decline in the bond market like we did, certainly not like we did last year. The failure of Silicon Valley Bank is a disaster for the employees and the shareholders of the bank. We expect to see a growing number of companies with weaker business models struggle. With higher interest rates and a weakening economy, the emerging cracks will become more apparent. For more detail on our analysis, you can download our quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.